This video is on the 2024 costing question. So in this year, flexible budgets came up, as did stock valuation. So there was a part A, flexible budgets, and a part B, stock valuation. So we'll take it bit by bit and we'll just start off with the flexible budgets part of the question. So here it says part A, Royston Limited manufactures a component for the computer industry. The following flexible budgets have been prepared for 50%, 75% and 95% of the plant's capacity. So we've got output levels 50%, 75% and 95%. And we've got units 20,000, 30,000, 38,000. So at 50% of the plant's capacity, they can manufacture 20,000 units. At 75% of the plant's capacity, they can manufacture 30,000 units. And at 95% of the plant's capacity, they can manufacture 38,000 units. So we've got direct materials, we've got direct wages, we've got production overheads, we've got other overheads, we've got administration expenses. Okay, so just to let you know, right, in costing, we've got different types of costs, okay? So we've got different types of costs. We've got variable costs that change as output changes. We've got fixed costs that stay the same. It doesn't matter what the output is. And then we've got mixed costs, which has variable and fixed. Okay, so we've got three different types of costs. Now, if we were just to take a look at this table here, we could see that the admin overheads here are fixed because at 20,000 units, it's 80,600. At 30,000 units, it's 80,600. And at 38,000 units, it's 80,600. So that is showing us that they are fixed costs. Now, looking at direct materials, if you put all of the following into your calculators, like so 90,000 divided by 20, 135,000 divided by 30, and 171 divided by 38,000, you would work out that that is €4.50 per unit. So as each additional unit is bought, it's €4.50 per each additional unit. If you divided the direct wages 300,000 by 20 and 450,000 by 30 and 580, you will find that the direct wages are €15 per unit. Okay, then production overheads and other overhead costs. So they are mixed costs, okay, because if you did the exact same thing as what we've just done for direct materials and direct wages, if you tried to divide these figures by, the number of units, they would be different for every single one. So you'd get decimal points and everything else. So that is how we know that they are mixed costs. Okay, so you've got, let's just go over that one more time. You've got variable costs that change as the output increases. You've got fixed costs that stay the same as output increases, and then you've got mixed costs, which have elements of fixed and variable. So the first part of this question is asking us to separate production overheads into the fixed and variable elements. So they want to find out for them, how can we find out what the fixed element is of that and the variable element of that. So what we need to do to find that out is we are going to use the high-low method. So the high-low method in order to do this, right? So sometimes they ask you to do workings, sometimes they don't. In this question, they haven't asked you to do the workings, but I'm going to do it anyway so that you can see how it's done, okay? So what we do is we have high-low method. So high minus low is equal to the difference. So we look at the units. So the high units is 38 and the low is 20. And so the difference there is 18,000 units. And then the costs, 191 and 110. That is €81,000 is the difference there, okay? So if you imagine the fixed element of this production overheads, the fixed is going to be the same, whether it be at 20,000 units, whether it be at 30,000 units, whether it be at 38,000 units. So any difference has to be variable, right? So variable cost per unit, 81,000 divided by 18,000 is €4.50 per unit. Okay, so €4.50 per unit. Now, when we know the variable cost per unit, we can then work out what the fixed element is, okay? So what we'll do is we will take away the total costs for the production overhead. So that's 110,000 at 20,000 units. Okay, we have 155,000 euros at 30,000 units. And then we have 191,000. We have that at 38,000 units. So what I'm looking at here is I am looking at these, so the 20, 30 and 38, and I'm looking at the cost, the 110, the 155 and the 191. Now, I will take away the variable element of that. So we worked out that the variable cost per unit was €4.50 per unit. So if I multiply 20,000 by €4.50, okay, what will I get? So 20,000 by €4.50, I'm going to get 90,000. If I multiply 30,000 by €4.50, I get 135,000. And if I multiply 38,000 by €4.50, I'm going to get 171,000. So what I will have then is I can find my fixed cost when I take that away, because I'm going to have 20,000 here, I'm going to have 20,000 here, and I'm going to have 20,000 here. So part A, my answer is that I have €4.50 per unit variable cost, and then my fixed cost is 20,000. Okay, for the production overhead. So that's the production overheads done. The next one, I'm asked to do the other overhead costs into fixed and variable elements. So I'm going to do the exact same thing. I'm going to do high and low. And remember, if it doesn't say for you to do the workings for this, you do not have to do the workings. But watch out, because recent years they have been asking for that, for you to do the workings. So just be aware of the easiest way to work it out. So high minus low is equal to the difference. Okay, so high, our units, they're exact same. 38 minus 20 is 18,000 units, whereas the cost 311,400 and 171. Okay, take away the 171,000 from 311,400, I get 140,400. Okay, and therefore my variable cost per unit is €7.80 per unit. Okay, so that's my variable cost. When I have my variable cost, I can work out what my fixed costs are. So we'll do it per all of the units then. So we had 30,000 units, 20,000 units, 30,000 units, and 38,000 units. So I'm going to get the total costs for the other overhead costs. So 171, 249, 311,400. And then we'll take away the variable cost, and in this instance it was €7.80 per unit. So €7.80. If I multiply 20,000 by €7.80, I get 156,000. If I multiply 30,000 by €7.80, I get 234,000. And if I multiply 38,000 by €7.80, I get 296,400. And that will then give me my fixed costs, and that would be 15,000 across the board. Okay, so that is the variable cost per unit, €7.80, and the fixed is 15. So over here, back in the flexible budget over here, we now know, right, that the production overheads are, okay, the production overheads were variable, €4.50, and the fixed was 20,000. And then with the other overheads, we had €7.80 was the variable and 15,000 was the fixed. So €7.80 was the variable and fixed was 15,000. So that is the first two parts completely done, right? We've got the first two parts done. Remember, it didn't say that we had to show the workings, but I just did the workings for you anyway. Okay, next part of that question is saying, prepare a flexible budget for 85% activity level using marginal costing principles and show the contribution. Okay, so that is just asking us to do, you know, something we do need to know. We do need to know the layout of a marginal costing statement. Okay, so I'm just going to copy this. I'm going to bring it down here if I can. Okay, all right. So look, we'll remind ourselves that it was €4.50 variable. This here was €15 variable. This here was it was €4.50 and 20 variable, then 20 fixed, and then this here was €7.80 variable and 15 fixed, and then this here was fixed. Okay, right, so part 3. So prepare a flexible budget for 85% activity level using marginal costing principles and show the contribution. Okay, so you need to know the layout for this. It's very important that you do. So this will come into play in marginal costing questions as well. So our marginal costing principles, so flexible budget, what we do is sales less variable costs. Okay, and then that will be equal to the contribution. Then I take away fixed costs, and that will be equal to our profit. Okay, so 85% activity level, right? I need to find out, right, what would 85% activity level be? 50% is 20,000, 75,000 is 30,000, and 95% is 38,000. So if I put any of those figures into my calculator, so for example, if I put 20,000 divided by 50 multiplied by 85, I'm going to get that my units are 34,000 units at 85%. Okay, so I'm going to get cracking. I'm going to put in my direct materials then. So materials, okay, so 34,000 multiplied by €4.50 per unit, and I will get that is €153,000. Okay, that's materials done. Wages then, 34,000 multiplied by €15 per unit is 510,000, and that's that done. Then I'll do the production overheads. So production overheads have fixed and variable elements in it. The variable element is 34,000 multiplied by €4.50 per unit, and that is 153,000. And then the production overheads here is 20,000 in the fixed element of that. Then we've got other overheads. So other overheads, 34,000 multiplied by €7.80 per unit, and that is 265,200. And then the other overheads, the fixed part is 15,000, and then last but not least we have the admin overheads, which were all fixed, and that is 80,600. Right, so I've all my costs put in. Okay, what I need to do now is I need to figure out, right, well, what's my sales, what's my contribution, what's my profit, right? Very important for us to see this sentence here. Profit is budgeted to be 20% of sales. Okay, so if sales is 100%, profit is 20%, that would mean that all of the costs would be 80%. So if sales is 100%, take away the costs, 80%, that leaves us with a profit of 20%. So into your calculator, you would fire all of the variable costs, okay, and you would get that is 108,200. Into your calculator then, you would fire all your fixed costs, and that would be 115,600, okay. So therefore, that is all of your costs, right? 108,200 plus 115,600, that is 119,600. That is 80%. If you divide that by 80 multiplied by 100, you will get then that your sales are 1,496,000. That's your sales. You take away your variable cost, and that gives you a contribution of 414,800. Okay, then you take away your fixed costs, 115,600, and that gives you a profit of 299,200. So that is part C done, which is preparing the flexible budget for 85% activity level using marginal costing principles and showing the contribution. And this is a huge thing that you're asked to do under flexible budgets and also marginal costing. We see this a lot. You just need to learn that layout. Sales less variable costs is equal to contribution, less fixed costs is equal to profit. So that's very important there. Okay, so we've got parts 1, 2 and 3 done now. Okay, now part 4 is saying, based on your calculations in part 3, calculate the break-even point and the margin of safety at 85% activity level for Royston. So this is unusual. This is the first time that they've actually done something like this in a flexible budget in question. People weren't expecting marginal costing, break-even type questions to appear this year, but it's just showing you how they're interweaving different types of questions into each other, so you can't leave out any type of costing here. Okay, so break-even point, the formula for that is fixed costs over contribution per unit. Now the fixed costs here, 115,600, but the contribution per unit, we don't have that yet. Now we do have a contribution 414,800. Okay, if we divide that by 34,000, we'll get that our contribution per unit, right, is €12.20. So if I divide that by €12.20, I'm going to get that my, in your calculator, 115,600 divided by 12.2, you're going to get that it is 9475.4098. But I hope you know you cannot sell 0.4098 of a unit. You would have to round up. So that answer is going to be 9476 units. So that is going to be your answer there for that. Okay, so that's your break-even point. Now, your margin of safety tells us how much your sales can drop before you'll start making a loss. So how much can your sales drop before you'll start making a loss? So the formula for that is sales minus break-even point. Okay, so the sales, all right, are 34,000. The sales are 34,000 units. That is at 85% activity level, obviously, minus the 9476 units, and the answer there is 24,524 units. Now, so that is part 4 done as well. Now the next thing that we're asked to do is explain with an example the term controllable costs. Right, so what on earth is a controllable cost? So it is what it sounds like. It's a cost that you can control, okay? So the management of the factory or whatever can control the costs. Okay, so you can make a decision, do we want to incur this cost or not? Okay, they're going to be responsible for the costs. All variable costs, for example, such as materials, direct materials, etc., they would be controllable because you can decide whether you're going to pay X or Y for a particular material. You know, you can shop around and all the rest. So that would be a controllable cost. So I'll just write down now what they have in the marking scheme for this. Okay, so this is what they had in the marking scheme. Okay, so control costs are costs that can be overseen by the manager of a control centre. So production department, for example. The manager will make the decision about the amount of the cost or if the cost should be incurred at all, right? And then they will be held responsible for any differences, any variances in these costs. So for example, all variable costs are controllable, such as commission to sales personnel can be controlled by the sales manager. So that is a controllable cost. Right, on to part B of this question then. So it says 2 Eat Limited is a retail store that buys and sells one product. The following information relates to the purchases and sales of the firm for the year 2023. On the 1st of the 1st, there was an opening stock of 5,000 units at €8 each. Okay, what are you being asked to do here? So required, calculate the value of closing stock at the 31st of the 12th, 2023 using the Fifo method and show your workings. Part 2, prepare a trading account for the year ended 31st of 12th, 2023. And part 3, explain the Fifo method of stock valuation and give one other method of valuing stock. Okay, so we'll do part 1 first. Okay, calculate the value of closing stock at the end of the year using the Fifo method. So Fifo means first in, first out. So if you can just imagine, the easiest way to imagine it is your local grocery store, your local Centra or Spar or whatever. They sell the oldest milk first. Okay, so they always bring the oldest milk out to the front of the fridge before they restock it with newer milk. So that is that's what first in, first out is. They buy the stock first, they're going to sell it to you first. So calculate the value of closing stock. So if we think about it, in this business here, they had an opening stock of 5,000 units. Okay, at the start of the year, they had 5,000 units. Then what did they do? Then during the year, they purchased goods. So if you can imagine, they've got more stock now. So they had 5,000, and then if we add 6,500 and 3,700 and 2,600 and 1,200, we're going to get that that is 14,000 units purchased. Okay. Now, what have they done then during the year? Well, during the year they have sales, but now you can see here that they've got cash sales and credit sales. So if we tot up, right, all of the sales all together, right, we will get, so the 1,900 and the 1,700 and the 2,900 and 700 and 200 and 1,900 and 2,800 and 1,600, that's going to be just all of our sales all together. And that is 13,700 if you fire that into your calculator. So that is, it's worth putting it in twice. So if you imagine, start of the year, you have closing stock. Then what you do during the year, you purchase loads of stock. So if you had no sales whatsoever, you'd have 19,000 units of stock. But what you have done is you have sold. So you add up all of your sales, okay? And then what you do, you take that away from your other figure and you get then, that is 5,300. That is your closing stock. Okay, so that is your closing stock in units. All right, so we have 5,300 in units, but you were asked to calculate the value of it using the Fifo method. Now, what we can see here, we can see that we purchased, you can see that all the purchases and sales, they're all at different prices in the different periods. So we have 4 different periods here, and you can see we're buying and selling at different amounts all of the time. Okay, and that could just be due to lots of different factors. Okay, but we have to work out, based on the Fifo method, what is the value of my closing stock. So we will have sold this first, so that would be sold first, then this would be sold next, and then this would be sold next, and this would be sold next. So the way that we would sell like this, okay? So we'd sell the oldest first, okay? So what we want to do is we want to say, right, okay, well, if we have stock left over in our warehouse, it is going to be going this way, okay? So we are definitely going to have the 1,200 at €10 each. Okay, so say we have 5,300 units. So 5,300 units. If we minus 1,200 at €10 each, okay, that's 12,000. All right. Then we minus 2,600 at 975. Okay, so 2,600 by 975 is 25,350. Okay, so at this stage we still have 5,300 minus 1,200 minus 2,600. We still have 1,500 left. So 1,500 then at €9.50. Okay, so 1,500 at 9.50 is 14,250. And that's going to leave us with no units. Okay, so that's how much our 5,300 units are going to be. So tot up your 12,000, 25,350 and 14,250, and that gives me €51,600 is the value of my closing stock. Okay, so that is my answer to part A. All right, so that's my answer to part A, 51,600, and that is using the Fifo method. Okay. So part 2 then is asking me to prepare a trading account for the year ended 31st the 12th, 2023. So a trading account for year ended 31st of the 12th, 2023. Okay, so I'm going to have my sales, okay, less cost of sales, opening stock, plus purchases less closing stock. And that will be equal to my gross profit. Okay, so how am I going to do that? All right, so what I need to do is I just need to work out for the sales, I need to work out the cash value of all my sales. Okay, so I need to multiply 1900 by 12 and then add that to 1700 by 13, then add that to 2900 by 14, then add that to 700 by 15, and add that to 200 multiplied by 11, 1900 by 12, 2800 by 13, and 1600 by 14. So we are on the calculator a hell of a lot there, okay? And you have to check it twice. When you get your answer, okay, it should be 179,800. Okay, now my opening stock is 5,000 units at €8 each. That is 40,000 euro. Okay, then what I have to do, I have to multiply out all of the purchases. So I'm going to have 6,500 by €9, add that to 3,700 by €9.50, add that to 2,600 by €9.75, and then add that to 1,200 by 10. And that is €131,000. Then what I do, I'm going to take my closing stock figure that I calculated using the first in, first out method, which was 51,600. That will give me a cost of sales when I tot all that up, 119,400. I take that away from my sales and my gross profit will be 60,400. Okay, so 60,400. Okay, so that is part 2 done. Last but not least then, we have to explain the Fifo method of stock valuation and name one other method of valuing stock. So explain the Fifo method of stock valuation and name one other method of valuing stock. Okay, so we haven't seen this question before, this theory question before. So as I explained to you, first in, first out, we're going to sell the goods that we purchase first. Okay, it's a very typical way of valuing closing stock. Okay, and you know, there's other types of methods of valuing closing stock, such as like the average cost or weighted average, standard cost, LIFO, last in, first out. So I'll just write down exactly what they had in the marking scheme. So Fifo, first in, first out, is a common stock valuation method used in cost accounting. Under the Fifo method, the earliest purchased or produced goods are sold or used first. By selling your oldest stock first, its price is represented as the most accurate estimate of each stock item. Alternative methods of valuing closing stock: LIFO, last in, first out, average cost, weighted average and standard cost. Okay, so that is the 2024 costing question completed. So 2 parts, flexible budgets and stock valuation, with a couple of like quite substantial theory elements to it as well. So do not ever neglect your theory. Okay, so reminder, costing questions, 80 out of 400 marks, which translates to 20% of your exam, and you should have no more than 36 minutes to do the question.